All right. Hello.
Hello.
Hi.
Hi. Can you hear me? I'm Sarah.
Yes. Hi, sir. I can hear you.
Yeah, thank you. I'm Stacy's sister.
Oh, yeah. She mentioned you'd be
I'm
joining.
in Taiwan, actually.
Oh my gosh. Okay. Well, thanks for joining. You might be the person tuning in from the farthest distance. I think. I'm not sure. But we'll see. Good to meet you, Sarah.
Yeah.
And thank you all the rest of y'all for joining. I know it might be a scary thing, but I was hoping some folks may be okay turning on their videos if they're in a safe spot to do so. Just makes this a little bit more casual, a little bit more interactive with the group. Any takers? Oh, Jason, stepping up. Eric, what's up, man? We'll get started in about I don't know, 4 or 5 minutes here. We'll let people hop in. Is that Leslie? Hi, Leslie. Good to see you. Stacy. Oh, Stacy, you said your sister is on too.
Oh yeah, my sister. Yeah, I'm late, but my sister was joining too.
It's okay, you're not late. You're
Okay.
3 minutes early. I don't tell people we start 5 minutes after
Oh, okay.
to give people a chance. This is cool. James,
You can have this if you want.
I haven't seen you. Last time I saw you was on a basketball court, I think, senior year of college 15 years ago. No, maybe I've seen you in between.
I hurt myself.
No, you didn't hurt yourself. I thought.
Thanks for having me.
Yeah. Are you down in LA, James?
Yeah, LA.
Cool.
Yep, been there a couple 3 years now.
Cool, man.
Yeah. Are you out in LA, northern NorCal?
I'm in NorCal. Yeah, I know.
Nice. Awesome.
Did you know Misun from Cal?
Yeah. Uh-huh.
Oh, cool.
Yeah, for sure.
Oh,
Wow, you got a good group.
We got 74 people who filled in the form, but let's see how many people joined.
Oh, wow.
Let me mute some people. Tian, I'm gonna mute you. Sorry. So we'll get started in a couple minutes, but good to meet y'all. This is I'll kind of get into it in a sec once we officially start, but this has just been such a cool experience for me because now this is the third time that I've hosted this class, and now it's a mix of folks that just were referred to the class and that I don't really know, but I want to get to know, and a mix of people who I haven't connected with in a really long time. So, and we'll get started in about 2 minutes. But I did mention, for those of you who are in an environment where you can turn on the video, would be helpful just to, I don't know, just
Hey,
to make.
Cliff, Wendy from TFA.
Oh my gosh, how are you doing, Wendy?
Hey, I'm using my husband Edmund's account right now.
Oh yeah,
I can't show
photo.
my face because Oh, sorry. Yeah, that's him at our wedding. But I can't show my face right now because I'm breastfeeding our daughter who's 6 months old.
Oh,
So,
okay. Yeah, okay, yeah. If you're driving or breastfeeding, no need to turn on your
Yeah, but now that we have a kid, it's like, how do we retire early by investing in maybe other properties like you've been suggesting? So very interested in this session. Thanks for hosting it.
Yeah, thanks for joining. Let me start to get some stuff ready. Let me share my screen. Okay, cool. We'll get started in 30 seconds. So yeah, but before we officially get started, I just want to say, yeah, welcome everyone. This is just the power of technology. Pretty cool that we can do this via Zoom. And it looks like we have folks joining all the way from Taiwan on this call. So this is super cool. Jack, good to see you. Yao, good to meet you and see you.
Hey, Cliff.
Kevin, it's been a minute. Good to
What's
see you,
up?
my man.
How are you?
Alan, wow, this is cool.
Hey man, it's been a very long time.
Yeah, thanks for tuning in. Okay, cool. So let's get started. So yeah, welcome. I was hoping this could just be interactive. So I kind of mentioned this a couple times, but if folks can just have their cameras on, it's not like I'm going to call on folks, but it's just really nice to see faces as I'm presenting. This is by no means like a lecture or something like this. The intent of this is to teach folks about real estate and see if real estate investing is something that you might be interested in. To kind of lay some background, how this class started. December of last year, I was on a hike with my wife. We were just kind of contemplating life. We're in Hawaii and just talking about, things that I miss. And I used to be a elementary school teacher many moons ago. And I was mentioning how I miss teaching. And also, I feel like I've learned a lot about real estate investing over the years. And so she kind of put two and two together and said, hey, why don't you think about hosting a real estate class for your friends? And so I thought, okay, that's a good idea. In March, I hosted this class for, posted it on Instagram, expecting, I don't know, 5 or 6 friends might want to join, and ended up being 30 people on that first class. So I was like, oh, this is kind of cool. Did it again in April, about 30 people joined. And then lo and behold, looks like this class, we have about 30 folks in attendance too. So that's really it, because I get a lot of questions from folks of like, why are you sharing this information? Is there a catch? What's the reason? I think on this call, looks like, I don't know, maybe half the people I've met over the years. Hopefully, there's not really a catch with me. I'm just trying to share what I've learned. And more importantly, for me, I think real estate investing has become so in vogue with folks, right? It's a really hot topic to talk about. So rather than having people to learn it the hard way, which is what I had to do, making some mistakes along the way, I figured, why can't I just be that person that literally pulls the curtain behind, shows you what it's like to invest in real estate, and then you can all individually make your own decision on whether or not this is something that you want to pursue on your own. So just as a heads up, like in this class, we're going to be talking about some numbers. We're going to be talking about, my experience real estate investing. And the intent of sharing those numbers is not to, I don't know, intimidate or scare anything, but just to show you my journey and give you a sense of what it's like having been a real estate investor for the last few years. And I should have also mentioned, feel free to chime in with questions either via the chat or just speak up along the way. I'm really hoping this can be somewhat interactive, just casual as a 30-person Zoom can be. Okay, so what we'll cover in this class. One, there's no way in 4 sessions we're going to cover everything about real estate investing. So my intent with this class is to give you a high-level understanding about real estate investing, and then you can kind of make that decision of like, oh, is this a curiosity that you want to itch and pursue further? And the other thing too that I want to just be upfront is like, my intent is to be a mentor, an advisor to anyone here who wants to start that journey in real estate investing. To me, it's been really cool. Over the first 2 classes, so about like 80 attendees, I've already seen 10 plus people buy their own rental property, buy their first Airbnb, invest in a syndication. Like that has sparked so much joy for me, just seeing people take that first step into real estate, something that was such a topic that you could really demystify. What does it mean to be a real estate investor? And then them for taking that first step. So we're going to break this down into 4 sessions. They're all going to be Wednesdays, 5:30 p.m. Pacific through September. Here's kind of the class schedule that you'll see. So today we're talking about why real estate? Why would someone embark in this crazy journey to invest in real estate? Maybe you know of other friends, maybe something led you to be here today because it sounds like, there's some curiosity there. Class 2, we're going to talk about how to pick a market. And I should mention the backdrop for this is I live in California. I live in Oakland, California. And generally speaking, it's pretty expensive to buy real estate in California. So my investment strategy has been to buy mostly out of state properties. My wife and I own a few in California, and I'll get into the next slide of kind of my background and my journey. But that's kind of the general gist of this class, how to pick a market outside of California effectively, and then building your team. We'll talk about property management, finding contractors, all of that stuff that's imperative if you're going to be owning out-of-state rental properties. Class 3, we're going to talk about analyzing a deal, running the numbers, underwriting, which sounds like a scary word. It's really just running the numbers, analyzing, and talking about negotiations. And in my experience, how those negotiations can unfold between seller and buyer. And then class 4 is a little bit woo-woo. It's going to be a little bit maybe weird for some folks on this call. We're going to talk a little bit about Tony Robbins, who's been, maybe some of you know Tony Robbins, he's been pretty influential for my life. So we're going to talk about kind of mindset and what it takes to be successful in real estate investing, because there really is a shift, in my opinion, in how you think about numbers and debt and those types of things if you want to get further along in the journey of real estate, and maybe releasing some of that baggage that we all kind of programming that we all grew up with from our parents and all of that. We'll talk about LP investing, limited partner investing, meaning if you don't want to directly buy real estate and own rental properties, there is other avenues to invest in real estate. And then we'll wrap up the class, and that's it. So my question or thought to you just is, if you, after today, you find this class valuable, can you commit to just joining for the next 3? And then I think you'll be in a good spot to decide, hey, is this something you want to pursue? Yes or no down the road. And then just general class structure. We start at 5:30. It's going to be 45 minutes of slides and kind of content with people jumping in with questions if they want. And then I reserve kind of last 10 or 15 minutes for official kind of Q&A that folks have. So this is kind of a little scary of a slide for me to share, just because I think most people on this call, I've known you throughout the year. There's some of the people on the call I've known you throughout the years, but maybe we haven't touched base in a few years. And just for me to kind of share openly what my real estate investing journey has been. So I started investing in 2013. My dad helped me buy a townhome down in San Dimas. And that was my first foray into real estate. It was pretty nice. I was kind of in the co-driver's seat to see what it was like to own a rental property. And believe it or not, like we did a pretty poor job, I would say, running that property. It was, we rented by room. We didn't even have leases for each of those folks. We didn't really track when the leases end, when start date. I don't know, we were kind of flying by the seat of our pants. But I had a really big aha moment pretty quickly on, which was the first time, I think this happens a lot with landlords. The first time you collect a rent check and then you set up auto pay or you pay off the mortgage for the rental property, it was like a light bulb moment for me. You know, I'll kind of never forget that moment, that thought, because it made me realize, like, okay, this is what real estate investors do. This is why people own rental properties. Because if I just keep doing this, I effectively, after paying off this mortgage in 30 years, will get a free home effectively. And also the aha moment was, that's what, as a renter for the previous 6 or 7 years, that's what I was doing for a landlord in other places. So kind of fast forward, 2016, my wife and I bought a condo in San Francisco. And then later in 2016, I was working at a small tech company called Hotel Tonight, and I got sold some of my equity that I got. So I got $150,000. And I remember at that time, I decided I'm going to start buying some real estate. So my first purchase was in Philadelphia, and I did something called the Burr Method, BRRRR, so 4 R's. And we won't really have time to get into the details of that, but if what I just said is new to you, I'd recommend writing that down. The Burr Method. It's in my opinion, one of the best ways to build wealth, period, not even just in real estate. The general concept of it is you buy a property that needs some rehab. So you rehab it, you rent it, you refinance the property, and then you repeat. And it allows you to effectively cash out that equity that you have in home, and then you can repeat the process. So I did that a few times in a little suburb in Philly called Manayunk. That market kind of got saturated with other investors. So I just started to expand into other places. Bought, some units in Kansas City with some friends, bought a 20 unit in Charlotte. This was back in 2019. And then at the end of last year, partnered with some friends as well. And we bought a 20 unit in Madison, and I bought some more properties in Philly as well. So that's kind of been my journey kind of in a nutshell. But I would say, it's been a lot of just kind of putting one step in front of the other. I've made mistakes along the way, and we could talk about that during the Q&A as well. But that's kind of my journey. So I've been, we have close to about 70 units at this point. And then in the last year, I've started to branch out to do something called like syndications, working as like a general partner. And that's just a fancy way for kind of fundraising, pooling money together with friends and other people to buy bigger real estate effectively. Oh, and I should have mentioned my day job. Some people always ask, so what do you, because I'm not doing this full time. So my day job, I run a real estate agent team here in the Bay Area. We cover San Francisco and Oakland, Berkeley, Alameda primarily. So very full time in real estate though, between both. So this slide is interesting, and just a couple things to note here. So this was last poll. This isn't fully updated. This was from 2018. This was just the screenshot that I was able to find preparing this. So the numbers here are going to be up, right? Real estate's actually up since 2018, as well as the stock market. But just to give you a sense, this top line here is a REIT, a fund of REITs effectively, which is a real estate investment trust, a proxy for real estate over the last 40 years. And then these bottom two lines are effectively the stock market, the S&P 500, the top 500 companies, and then also the Russell 2000, which is another stock market index. But I just like to point this out because I think for a lot of people, we know and kind of have heard, if you invest in the S&P, historically it's been an 8 to 10% return. And that's kind of the benchmark that a lot of investors use, because you can put your money into the S&P and it's a little bit set in and forget it. Right? You don't really need to do additional legwork. But I think it's illuminating for people to know that REITs, effectively real estate, has in some ways outperformed the S&P over the last 40 years. And then one also thing that someone mentioned to me kind of early on in my investing career that I thought was really cool is if you buy a rental property and you rent it out, and the rent only cover the mortgage and repairs. So you have no additional cash flow, right? Your rents cover your mortgage and you save some repairs, and that's it. So $0 cash flow every single month. Extrapolated out for 30 years, that's an 8% return. And when someone mentioned that to me, I was like, that seems really doable, especially in light of me owning that property in San Dimas where we cash flow a couple $100s a month, right? It's not game-changing money, but I was like, we didn't even really know what we were doing back then, and we're cash flowing, so that's got to be better than an 8% return. So that's kind of what started my curiosity in real estate as well. And just to be clear, in the past few years, for these kind of syndications of people investing in real estate, I think most people are actually targeting more than that 8 to 10%. You hear of returns of like 15 to 70%, even in the low 20% range, has been pretty achievable for folks over the last few years. We'll also talk about kind of the upcoming forecast. Maybe forecast is too strong a word, but kind of my thoughts on the real estate market heading forward, just because I know that's top of mind for folks as well, just because there's a lot about it in the news. And then one last stat that I had mentioned, this I haven't validated, but I think generally true, but also with what's happened to crypto in the last few months, the numbers might be a little bit off, but someone shared with me in the last 20 years, there's only been 2 asset classes or 2 general investments that have outperformed real estate in America. The first one is crypto. I don't know how that might have changed in the last few months. And then the other one is the NASDAQ, effectively tech companies, which makes sense because the tech market has generally been doing really, really well over the last 10 years. So we're going to spend a few minutes here on this slide, and stay with me, because this one I think is the crux of why real estate, why invest in real estate. And I know it's really text heavy, but the first piece here is it's an asset-backed investment. It's tangible. You can actually touch it. You can feel it. It actually literally provides a roof over your head. And I think that's one thing that, gives a lot of relief to folks who are investing, because it's an asset-backed investment. The next piece is leverage. And just so you know, leverage can obviously cut both ways, meaning when things are appreciating, things are going well, it can accelerate your returns, but also when things are losing value, it can also quickly diminish that as well. So it cuts both ways. And we'll talk about this too when we start talking about loan terms, but I think generally leverage is a good thing if used wisely, and if you're protecting yourself with the right reserves and kind of taking fixed rate debt, those types of things. Tax advantages. I should caveat by saying I'm not a CPA and not providing specific tax guidance for anyone's situation, but these things here were just complete game changers for me when I learned about them. In fact, when I first explained them to my dad, I remember he didn't believe me. He was like, "That's not possible, what you're explaining to me." So the two things here, 1031 exchange and step-up basis to heirs, I'll kind of give you two different examples and hopefully it'll kind of make sense. So 1031 exchange is a way for you to defer your taxes, meaning you'll defer them and have to pay them at a later date. But then when done in combination with something called a stepped-up basis for your heirs, you can effectively avoid paying those taxes. So let me give you two examples. So one, you buy Apple stock. Okay, and these are hypothetical examples. You buy Apple stock at $1, it appreciates to $1 million. When you sell it at $1 million, you have to pay what's called capital gains tax. Typically, 25 to 40%, depending on how long you've held it and what state you live in. So it chops what you actually keep. In that case, you'd have 600,000 to roll into the next investment, if that makes sense, and so forth. With real estate, there's a really interesting 1-2 combo that a lot of real estate investors do. The first one is the 1031 exchange. So you buy a piece of real estate for $1, it goes up to $1 million. When you sell that property at $1 million, if you do what's called a 1031 exchange, you can exchange it for a like-kind asset, meaning another real estate property, rental property, and you don't pay taxes at that time. You'll owe it in the future date, but you still have $1 million to roll into the next investment. But then that's where the step-up basis comes into play, which is when you die and you pass off to your property to your heirs, they get a stepped-up basis. So in that scenario, if they sold the property at $1 million, they wouldn't owe any taxes. If they sold it at $1,001, they would only owe taxes on that $1 because their basis is now $1 million. And that's just one round, right? Like you can imagine, and you can kind of extrapolate, like if you're doing this, if you're getting started now, like I'm in, my 30s, right? I don't know how many times someone can do this by the time they kind of retire, but it is something that folks can roll multiple times and you kind of start compounding your gains pretty quickly. The third one here, I don't think will apply to many folks on the call, but it's real estate professional status. If you're a realtor on the call, it's something that you really, really need to look into. Effectively, you can write off your passive losses from real estate investing. Usually you'll have those because of depreciation and other write-offs, but those write-offs can work against your active income. So when I buy rental properties, I have losses, paper losses, that I write off against my realtor income. This fourth point here, harder to sell, get rich slow. That one always kind of gave me a chuckle, but I think it's really an important point to emphasize. Like real estate is considered a get rich slow game, right? You want to just have time invested in real estate, but more importantly, the transaction costs are high, so it can be harder to sell. And I think sometimes people think that's a negative, but I see that as a huge positive. I always think of, when COVID started, I think if you gave a button to anyone who owned any real estate investing and properties, you gave them a button to sell all their real estate, I think most of them would have hit it. They would have said, there's no way we're entering a global pandemic, everything's going to get shut down. There's no way real estate would be good to hold on to. But because things are hard to sell, you can't really transact that quickly. It's not like clicking a button to sell Apple stock. It kept me in the game. And now in hindsight, that would have been a really, really bad move. And you hear this too a lot from older real estate investors, which is, the only regrets that they have are the properties that they sell. It's kind of the cliche that you hear in real estate investing. Next, more control over the returns. This is related more to multifamily, or if you're starting to own apartment buildings, but it really is a formula to derive the value of it. So the value of it is the net operating income, which is effectively your rents minus your expenses, so like kind of like the profit on the building divided by the cap rate. And the cap rate is kind of market specific. So you don't really control the cap rate, but you certainly control the NOI. So a good operator can buy a property that was poorly run by someone for the last 20, 30 years, come in, same building, increase rents, put together a better marketing and leasing plan. And within a year, if the NOI has increased because they're running it better, that property, the same building, without even necessarily doing improvements to the building, is worth more because it's super formulaic. Next, mortgages are usually protected by government. That's something that we saw in 08, 09. Generally speaking, if you have a residential loan for 1 to 4 units, even for a rental property, there really isn't a distinction on the mortgage side between what's owner occupied and what's a rental property. And so, you know, we've seen, even for example, when COVID hit, right, there was something called loan forbearance. There's just generally protections from the government of that. They don't want to see something dire happen to the real estate market, as we saw in 08 and 09. So not to say that's for sure going to happen next time, but there's generally been a trend of that. Risk can typically be mitigated by forming an LLC. We'll talk about that a little bit later as well, but just know that, yeah, you could form an LLC for asset protection. Cash flow, we'll talk about the math of owning a rental property in a few minutes, but that also offers protection. And then also this concept of the cost of construction. So generally speaking, cost of construction is, you know, depending on the market, $200 to $400 per square foot to build a property. But in some markets, like for example, Indiana or Indianapolis or other parts of the country, you can buy a home for $150 a square foot, $200 a square foot. So it's not to say that you can't lose money on that property, but it does offer substantial protection, in my opinion, if you're buying less than the cost for someone to even build a home. Can
One
start
question
investing.
on the LLC point, if I can ask.
Yeah, thanks.
So is the idea,
Thanks for asking.
yeah, no problem. Is the idea that if, let's say you invest in a property and you take out a loan for that property, and for whatever reason it goes underwater, like that liability won't bleed into your other assets or your, like the rest of your financial situation, and it's siloed? Is that the
Correct.
concept?
Yeah, exactly. Yeah, so there are some pretty strict guidelines when you set up an LLC. You want to set up business checking account, business credit card, make sure there's no overlap between personal and business expenses. But theoretically, it does offer that protection, and it's siloed. And
Got it.
usually people, they usually have some cap. Maybe they'll buy each building with a new LLC. So very common for folks in real estate investing to have, you know, potentially dozens of LLCs to silo each one separately. You have a slip and fall, you know, litigation on one property, doesn't mean that they can sue you and take all of your other properties. Yeah. So next, you can start investing with little to no money. We'll talk about it in subsequent classes, but that's always an option, right? If you just want to get started with a smaller amount, you don't necessarily need to buy the property fully to be a real estate investor. You can even own a REIT stock, for example, to get exposure to real estate. Hedge against inflation with fixed rate interest. I think that's kind of speaking to kind of what maybe a lot of people are hearing in the news nowadays, right? There's talks a lot of about inflation being 8, 9, potentially even double-digit percentage. Interest rates have ticked up for sure, but are you hedging against that if you're borrowing at 5% and interest rates are, borrowing at 5%, so your interest rate is 5%, but inflation is 10%. You know, I think some people would see that actually as a hedge because you're borrowing at a cheaper rate than the inflation. Cash out refinance proceeds, tax-free. This kind of goes back to the Burr method that I was talking about. So we won't have time to dig into it, but you know, do a quick Google search on the Burr method, and I think it'll be really, really enlightening to folks. And know that when you do that cash out refinance on the Burr, there's no taxes on that as well. And then these last two, they're kind of related. I've loved real estate because it's really multifaceted. It uses different parts of your brain. There's a marketing aspect. There is a financial analysis aspect, running the numbers. There's negotiations. There's deal hunting. It's just a very dynamic industry, but also related to that is you can outsource everything too. If you don't like marketing, you can hire a property manager to do the leasing for you. If you don't want to do any aspect of it, really, you can outsource. You'll still ultimately be the decision maker, but know that you can get a lot of help along the way. So this is coming from Fred. This is the Federal Reserve economic data. I just like to point this out because the next few slides, we're also going to talk about kind of headwinds and, where I think kind of the real estate market's headed a little bit. But I just wanted folks to kind of have a zoomed out view of the last 45 years of real estate prices, that generally speaking, it trends with at least inflation. And I like to point out that like 08, 09, which is considered a pretty disastrous time for the real estate market, when you zoom out, it was a hiccup for sure. And there was, a lot of, prices came down, but generally speaking, home values tend to go up over time. I always like to also mention the analogy, like, 30 years ago, if you picked almost any home in San Francisco, it could have been a bad decision at that time. Fast forward to now, I think you're generally doing pretty okay. But hard to say that same thing with other asset classes. Pick a random stock, sure, it could have been Microsoft or Apple, but very good chance it was a Netscape or something that's no longer around and you lost some money. There's a saying kind of that real estate has the highest percentage or highest number of dumb millionaires. And it gives me a good chuckle, but I think it's also generally true that it's a pretty forgiving asset. And if you can just stay in the game long enough, you'll do fine. You'll do okay.
And do you have a good sense for how much correlation there is with, maybe it's not interest rates and maybe it's more macro factors with like rental prices and income from real estate properties?
That's a good question. I don't know off the top of my head. Yeah.
Okay.
Well, I know you're pretty savvy on that. What are your thoughts, Alan? I'm just curious.
So I don't know this market very well. I think it's more of a personal interest to learn more from someone like you, or just learn more generally, and we can catch up a little bit offline. But I don't have a great sense, to be honest.
Okay. Yeah, I would say,
Because I think the idea, at least in my mind, is like long term, like property values, like I do believe they're going to go up, right? But if you get like a mortgage on something and you have an ongoing liability and something you have to pay, the only worry then is if for some reason like your rent comes down and then it impacts your cash flow and you don't have the liquidity in that period of time to continue paying your mortgage, I guess.
yeah, that's a great point, and we'll talk about that a little bit. That if you're planning to get into real estate investing, having your reserves, mitigating your risk, paramount, right? You need to just think of worst case scenarios and make sure that you have that backup there, because really the surest way to lose your money in real estate is to be a forced seller. But if you can avoid those forced seller situations like in 08, 09, and there will be some sort of correction or some sort of at some point, right? By avoiding that and sticking in the long run, I think you'll be okay. And as you're speaking, I think generally rents and all of that kind of trend kind of in line with one another. I don't know if they've like outpaced, for example, the S&P and those types of things. But maybe something I'll look into, and maybe next class we can talk about it. That's a really good question. So here's the next slide. Kind of understanding the P&L, the profit and loss, and risk. This was another aha moment for me as a real estate investor. So let me kind of walk you through this. And this is a hypothetical situation, but I think real, like harder to find nowadays because prices have come up. But I think this scenario of what I'm about to outline, people have been able to find as a real estate investor. So, and this assumes you buy a home for $100,000, you have 25% down, meaning you have the $75,000 mortgage. Interest rates are 5.5%. And funny enough, when I started this class in March, the same scenario was at a 3.5, but now we're at 5.5 on a 30-year fixed mortgage. $1,200 for property taxes for the year and $1,000 for homeowners insurance. So this is then what it kind of breaks down here up top. So you have $1,000 for rent. You have something called PITI, which is your principal, interest, property taxes, and insurance. That comes out to 608. So these are all like real numbers, right? Even though it's hypothetical. To start off with your underwriting, I would use 5% vacancy, 10% for repairs and CapEx. And that's just a fancy word for, if the furnace breaks, if the roof needs repair, anything that just general maintenance for the home, that's either shorter term or longer term. And just to be clear, that's not necessarily saying every month you're spending that 100. That's meaning if there's no expenses, you're still piggy banking that 100 because at some point there's going to be a cost down the line. And then 10% for property management. So after all said and done, this property cash flows $142. So not groundbreaking, right? You're not going to become a millionaire just by owning this one property. But a couple things for me that were the light bulb moment. One was thinking about how to kind of extrapolate this. If I own 1, 5, 10, multiple units, maybe that can start to give me the cash flow and some of the financial freedom that I was hoping to get. And then the other piece too is thinking about how much do rents need to go down before I actually start losing money? So I think most people look at this and go, well, I'd have to lose $142. So rents would need to go down 14% from $100 to $860 before I start losing money. And that's true. You'd be cash flow negative or break even at that point. But the one nuance here is in this payment of $608 every month, about $200 is going towards your principal. It's actually going towards paying down your mortgage. So that's profit effectively every year. So when I kind of understood that math, that it's really not 142, it's actually more like 342 rents would need to go down before I actually start losing money. It just gave me comfort. It's not to say that that scenario can't happen, but it seems less likely that rents could drop down by 14% and very unlikely that rents would drop 34%.
Can I ask one more question? Sorry for asking so
Yeah.
many questions.
No, keep
My
going.
last one for a while. How feasible is it to like insource the property management function? Like especially if you're starting off and you don't have, or you want to create more cushion on cash flow, like is it actually feasible to do it yourself, or do you always recommend outsourcing?
I almost always recommend outsourcing because I kind of think about the long-term view. Like you can manage 5 properties on your own, but if you're really trying to get to a scale where you have that freedom and you're not just constantly taking phone calls and effectively having another job, you're going to need to have budgeted for the property manager. So I think people run into trouble where they're trying to force the underwriting to make it look good enough without a property manager. And then down the road in 2 years, when they're busy, they have 2 kids, they're like, oh shoot, I need to add a property manager. And now it's negative cash flow. So I think best to underwrite it with it from the get-go. Yeah, but I'm sure there's some, random circumstances where it might make sense to try to avoid it. Yeah. Okay, so this is hopefully a quicker slide, but just wanted to outline some of the fears, questions that folks have brought up to me about like real estate investing. And so I just wanted to just throw it out there, right? And just be transparent. That's the whole point of this class, is to lead with transparency. There's no question that's off the table. Pull the curtain back, right? If you're curious about real estate investing. So first one, how passive is it to own rental properties? Kind of goes to what Alan was asking about. It's not 100% passive, even if you have a property manager. I want to make that like abundantly clear to folks that like oftentimes I'm on vacation and an email pops up. Is it a lot of work? Not really. I was trying to ballpark for folks like how much work is it? Hard to say because it really depends on like what tenants you have, where the property is, the vintage of the home. But I would say generally 4 to 6 emails a year per property. So it's not that much, but it's also, you need to be checking your email at least every once in a while. And property manager is the most important piece, at least in my opinion. And we'll talk more about that next week, about building your team. Should I set up an LLC? Generally, I would say for folks who are just getting into the industry, it's probably not worth setting up an LLC. In fact, this was the question that came up the most in the questionnaire for this class, of like questions that they wanted answered. I would say the amount of time that folks spend trying to figure out the answer to this question, it's just not worth it, because you can mitigate a lot of that risk by having an umbrella insurance policy. You can beef up the insurance for that property. And more importantly, you typically get better loan terms when the loan is under your personal name. And it relates back to what I was saying earlier about you get some protection there as well. If it's not a commercial mortgage, which an LLC's loan has to be a commercial mortgage. And then this last question is kind of like a thought for everyone. Like, do I really want to get into real estate, or do I just want exposure to the asset class? No need to make a decision now, but I think something just for people to mull on, right? Because it is going to be some work. I think it is worthwhile, but just know that LP investing is something that could be a better option, and something that I've started to turn my attention to as well, because of hearing this concept of, well, I used to think of ROI, return on investment, and then in last year, someone mentioned this idea of time ROI. So have you factored in the time that needs to go in to make that return? So for example, would I rather directly own in real estate and get, I don't know, 19% return, or I can invest as an LP and get 16% and not have to commit any time, any energy besides kind of cutting the check to that person. And we'll talk about the risks of LP investment in one of the classes too, but just something for folks to think about. And then these last two, they're kind of related. Is now the right time to buy? How do I even get started in this market? That question is actually a little bit dated, because I think now people are thinking the opposite, like they're nervous about getting in. What if prices go down, and are we due for a correction? I'm just going to start. I have no idea. If anyone tells you with forcefulness that they know what's going to happen to the real estate market, they're full of bullshit. It's just like there's no way anyone can know. But what I like to do in my classes is just share with folks how I think about it, and then you can make your own decisions. So you get kind of both sides of the coin. So the argument for prices to go down, interest rates, of course, right? And just side note, when you hear of the federal funds interest rate going up, that's not necessarily the mortgage interest rates. They, I guess, somewhat correlated, but it's not one-to-one. So that's definitely top of mind for folks, right? If interest rates go up, people have less buying power. It's harder to buy properties. And then this other thing of kind of the U-turn of other assets. And what I mean by that is, if you look at growth stocks, Zoom, DoorDash, a lot of these growth stocks, Spotify, they were flying high, 6-8 months ago. And if you just look at them, they've almost U-turned to where they were pre-COVID or at some point during COVID. And crypto, we've kind of seen that too, just looking at Bitcoin as an example. So the question on a lot of people's mind is real estate next? Or how far will real estate U-turn if it does start to U-turn? But then the other side of the coin of why, some folks might think prices actually may go up. I don't think that's likely at this point, or at least why they'll stabilize is international investors, right? We haven't really seen that many investors internationally come to the US to buy real estate over the last 2 years because of COVID. Inflation, of course, as prices go up, assets should go up as well. US affordability versus other countries, and I have a couple slides to show you on that as well. And then these last two, I think, are kind of the most important about why there should be some stabilization, or why people think there's stabilization. We're still at a historically low supply. And I have some slides to kind of show you that as well. And then unlike 2008 and 2009, there's a lot of equity still in homes. So kind of going back to what I was chatting with, mentioning to Alan, there in 08-09, there's a lot of forced sellers, right? And in those situations, people need to kind of fire sale their property for the lowest price and just kind of get out. But in this case, if there's equity in homes and people aren't forced to foreclose or forced to sell their home, then it won't, people think, hey, it won't reach those types of fire sale prices. So the next 4 slides, just to share kind of some data about the real estate market, because I know that's kind of top of mind for a lot of folks. So my takeaway here is just like real estate is hyper localized. And it's going to lead into our discussions in the subsequent weeks about picking a market, picking your team. But just know that like not all cities are telling the same story right now. Not all regions are telling the same story right now. For example, if you're in Northern California, where I'm at, there is a lot of price reductions happening. And it feels like, prices already come down 5 to 10% in the Bay Area, just to give you a sense. But in other parts of the country, for example, like the Florida, the retirement kind of markets, and the Midwest, which historically has been slower appreciation, higher cash flow, and less volatile, we're seeing that kind of shine through right now. Prices are just kind of steady. There's just less volatility with population movement in those areas in the Midwest. So just know that, the stories are very localized to the real estate market. And to kind of emphasize that, we'll go through these slides pretty quickly, but this one, for example, Houston, right? This is up to date through the end of August. This is looking, these dark brown bars is pulling August for the last 6 years. So you'll see that as of end of August, there are about 20,000 homes for sale in Houston Metro. And that's still well below 2017, effectively the pre-pandemic numbers. There's probably about a 50% increase in inventory before it even gets to about 30,000. Seems like there's a ways to go before a quote unquote like crash would happen in Houston, for example. But then in Boise, I wouldn't be looking to buy in Boise right now, or I would keep it on my radar, but I wouldn't today, for example, buy a property in Boise because you could just see that the trend is not heading in a good situation. Right, this is comparing to the last 6 years as well, and you'll see that it's well above already where it was in 2017. And then this was just a quick point about housing affordability between the US and other places. I thought this was interesting when someone brought this up because I never really kind of thought about real estate prices outside of America. The caveat here is these are a little bit dated. So this was from 2021, and I think both of these are 2021. Just so you know, since then, some of these other more exotic other countries like Canada, Australia, they've started to face some headwinds with their real estate markets as well. But generally speaking, like, the point of these two charts is that when you compare tier 1 cities in America to other tier 1 cities in other places, like Sydney, like Hong Kong, like Melbourne, there's the argument to be made that American real estate actually might still be pretty affordable and pretty cheap. So yeah, before we kind of wrap up and start talking about some Q&A, I just wanted to share some other resources with you all. If having sat here for 40 minutes, you're thinking, oh, this is kind of interesting, I want to learn more. I wanted to share kind of how I got started. So I got addicted to the Bigger Pockets podcast. Maybe some of you have heard of it. I see some of you kind of smiling. It was great. And I would encourage you, depending on how much time you have, I just started listening to it every time I went to the gym, right? Just starting to intake some of that information. And very quickly, you'll realize, oh, like if you're interested in this, or you kind of want to, pass on it. I also thought the Bigger Pockets forums were really, really nice wealth of information too. And in next week's class, when we talk about building your team, we'll talk about that a little bit more because that's a great area to figure out who a good property manager is in your local market. Nick Huber, he runs a podcast called The Sweaty Startup. I know it's kind of an odd name to say, Sweaty Startup, but he's really, really sharp as well. He focuses more on self-storage and talks about his experience kind of running those types of properties and also small businesses as well, but a good resource. And then this one, All In Podcast, not really real estate related at all, but this is probably my favorite podcast right now that I listen to. It's hosted by 4 guys who work in venture capital, and they're sharp, they're honest, they're brutally honest actually. And it feels like it's giving me insider access to a world that I just never, it's kind of like similar. They're just kind of pulling back the curtain and really sharing a lot of information. And it's really interesting to see how they think about the markets and the world. Social media, I'd recommend if you're on Instagram. I think most of you found me through Instagram, so I'd recommend following this account, Invest with Ace. He does these quick little segments, but I always say, hey, if you're trying to get into real estate, instead of scrolling through just nonstop photos of your friend, maybe start to ingest some information about real estate. 1 in every 20, now you might have Invest with Ace, and that could be really helpful. And then 2 books, The Millionaire Real Estate Investor by Gary Keller, and the book on rental property investing by Brandon Turner. Brandon Turner used to be the host of the Bigger Pockets podcast. Funny enough, I have the Millionaire Real Estate Investor book right here on my desk, actually. I don't normally keep it there, but for the class and for the theatrics of doing that moment, I put it next to my lamp here. But I would recommend like books and all those things, because real estate is really just a tried and true industry where there's not much reinventing of the wheel. You just need to repeat processes that have made other people successful. So, and maybe some of you have already heard this, but if anyone on this class is interested in getting copies of those 2 books, I will buy them for you. I will ship them out. no catch, no gimmick. That's what I've done for folks in the last 2 classes. So in this weekend's recap email, I'll just have a quick little questionnaire where people can punch in their address, and I'll ship them from Amazon to folks. The only ask is, hey, just take a look at them and potentially start reading them. Because if you follow what's in those books, it's absolute gold. You can do really, really well in real estate investing. And then the last thing here is Twitter. My mindset on Twitter has really shifted in the last few months. A couple of my friends who I really trust their opinions on how to get smart on markets and learn about things. I thought Twitter was just kind of a black hole waste of time, but they've really turned my attention to a few Twitter accounts that are really, really informative. These 2 I'd recommend to start off with: Calculated Risk, pure just stats on the real estate market. No judgment. You can interpret what you want from what he reports. And then News Lambert, I believe he is a writer for Fortune magazine. So just a really good resource to get smart on real estate. That's really it. Yeah, we'll kind of jump into some Q&A with folks. Oh, a couple things here. One, if you're not following me on Instagram yet, would encourage you to do so. That's where you'll see a lot of class announcements and also just a fun way for us to connect. I'll send out a recap and recording of this class over the weekend. Respond with your mailing address if you want copies of those 2 books. And then I'll always just have this here. If anyone wants to just book time, just to chat, just to catch up and just talk, I'm always available, and you can book through that link. The last thing that I'll close with before we hop to some Q&A, I skipped this, which is, what is my take on the real estate market? This is my personal belief, right? I've generally kind of taken a more prudent kind of, I don't want to say a wait and see approach, but generally speaking, I would say I'm still looking at deals, but I've kind of mentally said, hey, at least for the next 2-3 months, I'm trying to find more reasons to say no to a deal than to say yes, because I just want to see kind of how things shake up over the next few months. I think there's more risk, more potential for loss than more potential for gain, if that makes sense. So I'm just taking a more prudent angle on it. But I do want to emphasize that if that sounds similar to what you think you want to do with the real estate market, there is no better time than now to start practicing underwriting, getting smart on real estate and all those things, because when the market turns to be more favorable to investors, you're going to miss out on stuff. And if you're trying to learn in those moments, it's just going to be a lot harder. It's going to be a lot harder to build relationships with real estate agents and real estate brokers. It's just going to be harder to find deals and all of those types of things. So now is the time to get smart on all of those things, in my opinion. So that's it. Yeah, maybe we'll just open up the floor to questions now. I'm going to read through the chat as well.
Hey, Cliff, this is Wendy. Thank you so much for the class. Super helpful. I had a question. How do you, let's say you're buying a different city, do you fly there to check out the property, or do you do everything virtually online? Or what do you recommend, if you first start? Let's say if we want to buy in Austin, what would you do next?
Yeah, okay, that's a great question. I would say it all depends on how quickly things are moving and how much time you have. Ideally, you're flying out there and seeing the property in person every time. But I bought a couple properties sight unseen, which I know sounds crazy to some people on this call, and we'll talk about this when we're talking about building your team. I would say it's not necessary, right, to fly out every time. For example, if you're submitting offers on 3 homes that all work out, you might not be able to just fly out that 3 that come up every couple weeks, not 3 in one shot. Of course, you could see all 3 if you fly out there one time. But between your contractor, who you should trust, your property manager, and your real estate agent, if all 3 of them are aligned and do a Google video tour with you and you feel really comfortable about the property, I would say you might want to still consider submitting an offer if you haven't seen it in person yet. And there's a ton of research. We'll get into this too about picking your market, but I think data is a little bit more objective than if you fly out, right? And I've flown out before and you see the home and you tour and you're like, oh, the neighbor 2 doors down is throwing a party. You're like, oh, this is a bad neighborhood. Versus if you're actually looking at the data and seeing what crime rates are like, what the schools are like, average income in that neighborhood relative to rents. There's a lot of data, I think, that can help you make that decision without you having to see it every time, but you should still have some boots on the ground. Yeah. Does that help, Wendy?
Yes, it does. Thank you.
Hey Cliff, I'm Jen.
Okay, Jen.
A little bit about kind of your perspective on starting with Airbnbs versus a rental property.
Yeah, great question. And where are you two at, Daniel? Are you in Singapore?
We're in Manhattan. We're based in New York.
Cool. Oh, thanks for tuning in. It's like 9:30, late for you too.
We're the
Yeah, thanks for tuning. Okay, so I'll start off by saying that's not my forte about Airbnbs, but I think I have enough to kind of guide people with the general first couple thoughts about it. Airbnbs are kind of all the rage right now, and I think there's a lot of money to be made. So when I was giving those return numbers, that was for more like long-term real estate hold, 15 to 20%. I know of Airbnb investors who won't even look at a deal unless it pencils out to be 25 to 30% cash on cash return. Like some people are doing really, really well, but just know that there's regulation risk. That's probably top of mind for folks. Like very quickly, if a local municipality says you're not allowed to Airbnb, you're kind of SOL, right? Potentially. And with that higher return, there's usually more work. You're going to be managing people more proactively. Even a property manager, to give you a sense for Airbnbs, charge anywhere from 20 to 30% off the top. But even still with that, folks are still getting their own 20, 25% return. Just to give you a sense of kind of how lucrative it's been for folks. So I think, yeah, really, really worthwhile to consider. I think this kind of relates back to, and we'll talk about it in class 4 about mindset. There's no right path about real estate investing. It really becomes for you and Daniel, if you guys are thinking, I really am interested. I really think running an Airbnb would be a lot cooler than owning a single family home in Philly with long-term tenant leases. Then it's probably the better decision for you, right? And you'll kind of start to go down that path and start to build your real estate portfolio. But yeah, something I would really recommend looking into, Airbnbs.
Hey, Cliff, quick question. So you obviously have kind of done mostly residential, it sounds like. I'm curious how you decided residential versus commercial and kind of, to the extent that you have any thoughts about the differences between the two. I'd be curious to hear those.
Yeah. Hey, Bentley. Are you tuning in from Miami?
I am.
Wow. I'm late for you as well, so thanks for tuning in. That beard is as healthy as always. Thoughts? Yeah, so I would say for me, like I stumbled into residential real estate just because it was what I was familiar with. Like that made the most sense for me, having been a tenant for a long time and just, and also with that experience with my dad, I just felt most comfortable with it. But there's also a lot, like folks do really, really well in commercial real estate as well. Know that it is much more mathematical. It is very much NOI divided by cap rate. It's very formulaic. And it's kind of how do I say it? It's kind of like a different game. It's like, I don't know, maybe the analogy is like basketball versus soccer. It's still a ball sport. You're still kind of in the same arena. You got to be athletic, but it's just kind of a different game. There are some opportunities in commercial that are generally lower return, but much more passive. And those are some of the things that I've started to think about as well as Misa and I are thinking about kid and just, I know I'm going to be busier. And that's called triple net investing, if you've ever heard of it, and it means it's net of property taxes, maintenance, and insurance. And so effectively what that means is the tenant pays for all of those things. And so you're just kind of, that's when you hear of like mailbox money, that's usually triple net rent. And that's all commercial. That's like if someone, for example, a high, really nice triple net property might be like if you own the local Walgreens or the local Starbucks, because Starbucks and Walgreens usually don't own the building, of course, they're just renters. but those are high-class tenants. They publicly traded company, good financial statements and all that. So high chance of you collecting rent, and they're usually signing up for 5, 10, 20-year leases. But know that return is high single digits, for example. So yeah, I think maybe to answer folks' questions about different types of real estate, I just think of everything kind of on a big spectrum. There's stuff that's safer, like the triple net generally. Like that's probably as safe as you can get, right? Owning the local CVS or something with really high class tenant. And then all the way on the other end of the spectrum is maybe like fix and flip, right? Where you're like taking a lot of risk, you're holding on to these real estate, and if the market continues to turn, it can be really scary if you have like 6 projects going on. And usually those fix and flip projects are 10, 12% interest rate, because those are short-term debt effectively. And then Airbnb might be here, long-term rentals might be here. So it's just all on a spectrum of where you want to be investing and your own risk tolerance as well. Okay, Rendy asked about thoughts on the SF market as a potential seller. I would say it's a little nuanced. I would kind of ask, thinking about if it's a condo versus a single family home. And also what your plans are with that capital once.
Yeah.
Oh, Randy, you're here. Oh yeah.
I'm
Sorry.
here. I'm here. Thanks.
Randy.
Nice to meet you.
Hi, good to meet you.
It is a condo, and we really just want to turn it for reinvestment, likely outside of California.
Oh, gotcha. Is it currently a rental?
It is.
Okay. And when did you buy it, or has it appreciated?
Probably not much. We bought it in 2018.
Okay, because that was my first question, because I don't know if you caught the part about the 1031 exchange.
Yes.
If it had appreciated, that would probably be my first avenue that I'm thinking about.
Yep.
So if it's kind of flatlined, but you do have thoughts on how you could kind of reallocate that capital. And maybe this is something we kind of even chat about offline, but my next questions are like, which neighborhood is it in? Because it's nuanced. The San Francisco neighborhoods like Noe, Cole Valley, those are ones still that are selling pretty well. If it's in Soma, I think that one I would probably just wait and hold a little bit, just because prices have been depressed and have kind of stayed that way. So
Yeah.
it kind of depends on
It's
the
Mission Dolores, but I'm happy to book some time with you, Cliff, offline if you don't mind.
Oh, sure. Yeah. Mission Dolores, I would bucket that in with Cole Valley and Noe. That's a very, very nice neighborhood. So.
Yeah, it's a good location. This is Greg. Hey, Cliff. One other point is it was actually a gold mine as far as an Airbnb during COVID. Unfortunately, the restrictions in San Francisco on Airbnbs is 90 days. So, I mean, we could have it rented all year long if there weren't those restrictions. So you don't know if there's any plans to change those restrictions by chance?
I don't, yeah. I don't follow it too closely, but generally I would think that there's kind of a lot of resistance to letting folks Airbnb more. Kind of once the rules are set, it's kind of tough, yeah. But I'm really glad that you brought that up too, because I'm guessing you don't know Daniel and Jennifer, but that was kind of a nice little thing for them to see how regulation can affect.
Yes.
Yeah. Okay, someone asked about how to determine when the market is favorable or finding a good deal. We'll talk about that next class, picking a market. And I'll kind of show you kind of my methodology, some of the things that I think about. Just as a sneak peek, the general takeaway that I would say is there isn't a right answer, but there certainly are some wrong answers, I would say. There's a good amount of really good markets, in my opinion, and you can't really predict the future, but there are some markets that I would say you kind of want to stay away from. And, generally speaking, we're going to be looking at population growth, stable employer base, right? You don't want just like my one example. If this was a deal that I looked at one point, it was like, oh, do you want to buy this 30-unit property? And when I dug into it, it's like the Tyson chicken farm was the only local employer. And if that chicken farm closed down, it's like, whatever, 20% of the people don't have jobs. It's like, that's too concentrated, too risky for someone. Jason asked about what are the biggest pitfalls you've seen. I know we're over time as well. So if folks want to hop off, we're just kind of kind of run through these last few questions here. But in terms of pitfalls, I would want to share that the journey for me has not been like linear in terms of like just making progress. I remember the first property that I bought in Philly, and I think maybe I've shared with some of you who have known over the years about this experience. I got scammed. I effectively got sent fake photos from the contractor. So they didn't install any of the plumbing. Like the vanity was against the wall, but not attached. When you open up the kitchen sink underneath the cabinet, there's no plumbing there. It's just all fake photos. And I remember just, it was a tough moment because it was my first time and I was just thinking, do I just get out of this? But I guess hindsight's 2020. There's a lot of silver linings, but through that experience, I got a lot smarter, learned how to deal with contractors, but also found a really amazing contractor who I still keep in touch with today. And whenever I go to Philly, we go to like a Sixers game. So I don't know. I'm kind of just one that tries to stay optimistic, and there's always a learning opportunity. But I share that because that was, you know, it was at the time it was like a $20,000 loss that I had to recoup. I eventually did by kind of threatening litigation against the contractor, but it took about a year to get that back, just to give you a sense. Someone asked about the benefits of getting your real estate license. I would say the big misconception is real estate license might not necessarily make you a better real estate investor. I'd say generally speaking, most real estate agents, a lot of the stuff that we talked about on today's slide about NOI divided by cap rate, how to run the math on a rental property. Generally, I would say most real estate agents aren't thinking in that way. You know, I don't want to generalize and say all, but I think most. So that's the thing. And if you are thinking about getting your license to save on the, you know, the commission to buy rental properties, my opinion is your time is better spent paying a professional to help you with the negotiation and run that part, and you stay in your lane. If that's finding more deals, talking to property managers, or even just relaxing during that time, for you to try to learn this whole new skill set of how to negotiate and do that contracts and all that stuff, in my opinion, not really worth it. Yeah. And I should caveat too, because I think I said something kind of bad about real estate agents, or could be perceived. A good real estate agent is certainly worth their weight in gold. You know, they are a critical partner in your real estate journey and investing journey. Bentley asked about deal flow. We'll talk about that in a subsequent class about deal flow and kind of how to find them. I would say it's funny. 3 months ago when I first started this class, I mean, I didn't really have a good answer. You know, everything was just flying like hotcakes. Hard to find a good deal. And then funny, fast forward now, things are sitting. And I mentioned to y'all that I would still kind of wait a little bit, but it's funny, the psychology has changed of people. It's like the people who were buying 3 months ago had to buy. And now, even though prices are down 5 or 10%, people are now hesitant. They don't want to buy. So I think that's another thing we'll talk about in class 4 of mindset, is like, you need to kind of overcome that mindset and that fear. Because if you're waiting for the herd effectively to make a move, sure, you have some assurance there and maybe some safety, but you're also probably paying top dollar every time, right? And if it gives you comfort of some of these slides that we talked about of, hey, real estate trends up over time. If you're not a forced seller, you're thinking about reserves, you're generally going to be okay. Hopefully that gives you some comfort of like, okay, maybe soon-ish is a time for me to make one move. Real estate. And then Edmund or Wendy asked about learning about regulations, tenant protections when you enter a market. That is something we will talk about too. That is one factor, that's a big factor actually, about tenant friendliness or landlord friendliness. It's generally a reason why the most savvy real estate investors that I know aren't really looking to invest in California. Some of them, I mean, are explicit as saying, we don't even look at deals in California, just to give you a sense. And that's why a lot of these states like Texas and Florida, there's been a big upswing in real estate investor activity because they're generally considered a lot more landlord friendly. So good question. That is stuff for us to talk about in the next class. So that's it. Any other questions? All right. Well, thanks for staying late. Thanks for the little applause emoji. This has been really fun. And really great to meet you. I don't know if Sarah is still on in Taiwan, but just thanks for everyone for joining from all over the place. This is why this class has just been so cool. People ask, why do you even host this? I'm like, I don't know. This is so cool to have friends that I haven't talked to in years and find a way to connect with people and share kind of stuff that I've learned over the years. So I thank you for your time, and hopefully I'll see a lot of you next week at the same time.
Thanks, Cliff.
Thank you.
Take care, everyone. Bye.
Thank you.
Thank you. Bye bye.